And another regular spotted here from time to time, and very popular too. Last time he was here, Paul from Fiduciary Wealth Management, live from Gibraltar this morning to talk about finance and wealth. How are you, Paul?
Very well, thank you, Carl. And you?
I'm pretty good. Yeah, lots of blue sky. As I look out across the well-pruned vineyard from the studio, I can see a beautiful Portuguese blue sky, which is what I came here for. Similar in Gibraltar, some nice weather.
Absolutely. Fine weather, and it makes such a big difference, yeah, mentally when you wake up in the morning.
Lifts our spirits. So you're here to give us a quick market and finance report. It's always great to talk to you. Last time we spoke, I went out and bought some gold and silver, some stocks in a mining company, and some cryptocurrency. I got quite excited. Calm down, everybody. I only bought 10 quid's worth of gold and 10 quid's worth of silver and $10, I think, of mining stock. But very interesting to see how it works from the brief education you gave me. So what's your overview at the moment of matters financial? You know, we've had a budget in the UK. People are waiting to be vaccinated around the world. What's your generalized picture before questions start coming in from people about finance and wealth at the moment?
Well, I think we're experiencing a lot of market volatility because there's great uncertainty. And what we are seeing is the US 10-year Treasury bond yield rising exponentially, and that has a very negative impact on equity markets because, you know, if the 10-year US Treasury bond is paying a higher yield, then low-risk investors would rather hold a safe investment in US Treasuries than invest in equity markets. So normally there's an inverse relationship between yields or treasury yields and equity market valuation. So this rising of yields is a concern. Now, the Federal Reserve and the Federal Reserve can do one of two things. They can allow this the US yield curve to continue to steepen upwards, which is going to result in the stock market crashing, right? Not just in the US, but it'll be across the pond and globally. We'll see a major stock market correction, or they can revert to the policy that they have been pursuing since 2008, which is yield curve control, which is effectively quantitative easing, printing more money, and through the printing of money and quantitative easing, they bring the interest rate back down to zero, and that would be positive for markets. So I think they are between excuse the pun, between a rock and a hard place. Either they let yields to rising uncontrollably, or they decide to control the yield curve and save the stock market, but they can't do both. So either they salvage the stock market and the economy for now, or they let yields rise to new highs. And of course, higher yields also carry a problem for a lot of governments in that, at least in the US, you know, there's the debt servicing costs, will go up as well, which governments can't afford right now. And right now there's the volatility because what we've seen is there's a US stimulus package that went through, I think, through the Senate or through Congress over the weekend. And I think it's about to be rubber stamped and come into effect on the 14th of March. That will allow for further quantitative easing, helicopter money being given in the US to individuals. So it's the biggest wealth transfer in history where people are just giving money to spend to keep the economy afloat. So that in terms of the market, that's what we're seeing now. So we are, you know, at an inflection point, I would say.
Okay, amazing. And it sounds to me like it can't go on forever. Okay, am I right?
It can't go on forever. You know, more debt now means debt now equals less growth in the future, right? Because you know the debt has to be repaid. You can't have the cake and eat it. You know, you start growing that mountain of debt, and at some point it has to be repaid, and it has to be repaid through taxation. So really, debt is deferred taxation. That, and the taxation will result in lower corporate earnings, so lower stock market valuation. So we are at an inflection point, and we've seen it with the UK with the budget, right? They've done some things to keep the economy afloat short term. So, the extending the furlough scheme. I think they are. What else did they do? They did a few other things which were very short term. Stamp duty extension as well to keep. Is that the housing market? I think it was.
Well, it's fascinating because, understandably, the Conservative Chancellor is being described as behaving in a socialist manner, and that's the crazy thing in the world at the moment, isn't it? Is that you have what would have normally been sort of libertarian governments acting in a very socialistic way, but I suppose they have to at the moment because they need to look after people.
Actually, it's a very great point. This is what a lot of academics talk about, the Great Reset, that we are shifting from a free economy to a command central state-controlled economy like Russia and China. Inevitably, because government owns everything, and they're holding the levers of power through the printing of money. So, and look, going back to the Chancellor in the UK, you're right, but I think he's in a difficult position. So he's done all these short-term measures to keep the economy afloat, but equally he's taken the view, and probably rightly so, that corporate tax, which was 19% and due to reduce to 17, I think it was, he's now decided that in 2023 it's going to go up to what, 23 or 25%. To try and raise more tax revenue to cover all that debt that we've amassed over this pandemic, but higher corporate tax rates, lower corporate earnings, lower stock market values. But he hasn't done it today. He's doing it in 2023 because he knows that if he were to do that now, first they wouldn't be re-elected, and secondly the economy would tank.
Right.
So there are difficult decisions to make. In fairness, no easy decisions.
Let's see what questions might be coming. This is fascinating stuff. Paul is here to give his observations. This is shouldn't be taken as advice, okay? These are observations as we look upon the financial world, the markets, and of course you can work with Paul. You can find him in our business directory at expatsportugal.com. Paul and the team help people manage their wealth, and particularly good with transferring of pensions, right, Paul?
Yeah, that's one of the areas.
Okay.
One of the many areas.
One of the many areas. Okay, so yes, Paul and Louise are tuned in from the UK, from the Mesa da Cocina, from the kitchen table this morning. Jean Van de Beek is in France. Bon dia to you. Bon dia to Gregor down there in Algarve, over in Alvagra. Bon dia tourists from Gary. No questions so far. Hi, hello, good morning from England. Wishing to be there, but it's life. We can't have it all. So happy new day to all. That's a very philosophical position. Diogo, as ever, good morning to you. Jeannie King is here from the States. Bon dia, Torush. Julia McIntyre, bon dia. Lots of greetings for you this morning, Paul. Andy, the doc, here's a question. Who owns these trillions of debt? And what would happen if a number of countries collectively defaulted or at least adopted the severe haircut approach? We're all looking for a severe haircut when we come out of lockdown, but economically speaking, what do you say to this? Who owns the debt?
Well, if I may answer the first question, I mean, the haircut I'm losing my hair very rapidly, so I mean, I don't think I'm in need of any haircut, unfortunately. But going to economic matters, I doubt it very much if advanced economies are going to default. I think there would be a loss of face. I think, they would find it very difficult to raise. They would find it very difficult to raise debt in the future if they were to default. But I mean, a severe haircut is one of the options on the table, and one that I have advocated for a long time. I mean, unfortunately, it's investors in government debt paper that will pay the price of all this debt that we have amassed. But a haircut would the main benefit of a haircut is the national debt would be reduced, significantly at the stroke of a pen. But of course, those holding the debt won't be happy. If you're paid, £60 for every £100 of bonds that have been issued by a government, then of course it's the investor that carries the can for bad economic management.
And of course, the investors aren't just the fat cats, as some people might characterize it. They are the people who get paid from pensions as well, right? So in a way, you're hurting yourself, right?
Absolutely. I mean, unfortunately, the ones that carry the can are those, are middle and lower earning individuals rather than the rich and wealthy. That's a reality.
Yeah. Okay. Andy, he's here twice. Look, hola, bon dia, Delaria. He's here later on, folks. When Paul leaves us to return to his multi-screened office. I don't know. I've got a vision of you, Paul. Like in Gordon Gekko from Wall Street. Surrounded with the screens and the fancy office. Is that how a modern a financial and wealth advisor works these days?
No, when I was younger, I used to have my Bloomberg screen in front of me, but unfortunately, it's somewhere else in the office. But okay. No, yeah. I mean, you should really be tuned into what's happening in the market on a second-by-second basis. And okay. I think this is unprecedented times because the volatility, I don't expect the volatility to reduce. I think it's going to, if anything, increase moving forward. I mean, some sectors of the economy are going to do well, because, as we transition from a pandemic to a post-pandemic world, yes. Leisure and travel and those sectors should do well, and those sectors which are more cyclical in nature, materials and so on, are going to do well, and tech is probably going to suffer a bit more shorter term.
And everybody has access to this information now, interestingly, don't they? In those old days, with that stereotype of the financial guy with all his screens, you can see that all on your phone now, can't you?
I mean, I think investors are more financially savvy now than ever before. I remember in the day when I started, they were completely financially literate. But now investors can be, you can have a fantastic conversation and they can be, completely conversant and knowledgeable on financial markets because of the access to information we have nowadays. So absolutely right.
Yeah, okay. So bon dia from up there in the north, from Joel, and from California. Hola, bon dia, friends, from Hank there. Mark Rigby up in the north. Bon dia de Pavo de Vajim. A great question from Gary now for you, Paul. How come the pound is rising when we were led to believe that it would crash after Brexit?
Don't believe everything you hear from politicians. That's
a simple answer.
But it's a great question. Look, I think the pound was, firstly, I think the pound was considerably undervalued. I think it still is. Right. I think the euro as an economic area will endure more problems moving forward. The pound, I think, is vulnerable, maybe shorter term, because of the turmoil of, they've done a trade agreement, but until they sign trade agreements globally to make up for the loss of, economic output from crashing out of the EU, and that may take a bit of time, but medium to longer term, I think the UK economy will be very, very strong, stronger than the EU. The EU is a fragmented club, and they're not moving fast, and they're not moving anywhere. And I think they carry a lot of debt, and there's a lot of politics involved. I think the UK is a dynamic entrepreneurial nation, and I think they'll come back very strongly. The pound has always been undervalued. I think the mere fact that we didn't have a trade agreement and there was uncertainty weighed down on the currency. And, I checked it last night. Gary and I were surprised to see it was 116.15, but I reckon that it should be 120 minimum.
Wow.
So for me, it's not a great surprise. I think, politicians are politicians, and they try, whether it was the yes campaign or the no campaign, they will distort the truth to achieve their own political ambitions and objectives. I think the pound will bounce back, and whether it goes to 120, but it's certainly undervalued now.
You make a really good point there. So don't believe everything from the immediate political horse's mouth. Look a little bit beyond, and you were seeing a richer picture in the longer term post Brexit there, right? And maybe so possibly the Singapore of Europe.
Well, I mean, interestingly enough, the worry that the EU has, and that's why the trade agreement was told, is that Europe would have a very dynamic financial center in their doorstep, right? Yes. Within Europe, but not part of the EU. Yeah. And they could effectively lower corporate tax to compete on taxation, and then attract new businesses from the EU. That has been their main concern. So what the Chancellor has done, which is a necessary evil to increase corporate rates, goes against the whole philosophy of, Boris Johnson and his government about reducing corporate tax to attract business into the UK. And I think, you know, once the debt or part of the debt is paid and things are, you know, on a more stable keel, I think they will revert back to that policy of competing on the basis of lower taxation.
Fascinating.
You know,
okay, I know you've got to go, busy man, but a few more minutes if we may. It's a bum deer for me there. I'll take that. Hey, Carl, good morning. You're doing a great job. Thank you. In Northern Ireland, the government is giving huge amounts to individual businesses right now. It's true. This helicopter money that you mentioned, it's happening, isn't it, all over the place? Bon dia, Toros. Maybe we'll go to universal basic income. I mean, do you think that's going to happen, that citizens around the world will just be given money to live?
You know, we're living in a strange world. Look, if you start giving people money, what is the motivation to produce and to produce output? But I think we are shifting, as I alluded to before, we are shifting from a free economy to a state command-controlled economy. See, if they give you money, they have all the power, right?
Absolutely.
Because you become dependent on them, and then there will be just government and the ultra wealthy controlling the rest of us. So, you know, I'm dead against the thought that someone just hands you money and gives you enough to survive, right? Yes, very dangerous, very dangerous world.
I imagine we might be talking with the doc about this after you've gone. But thank you, Paul. Helpful insights from Shelley. Let's see if there's any more economic financial market questions before you go. Gordon Brown did exactly the same thing to counter the financial crisis at the time and was criticized for it, but did cushion us from the effects that most of Europe faced. Is that right?
Well, one thing about Gordon Brown, and I think it's worth mentioning, and I did a little piece for clients on Gordon Brown. He was the architect of the G20 summit in London in November 2009, in the midst of the global financial crisis. And he, you know, he followed this famous UK economist, John Maynard Keynes. Yeah. And Keynesian policy was, you know, in times of economic strife, you know, you raise debt, and, you know, to keep it's government spending, right? Spend government money to revive the economy. But there was one thing that a lot of the larger countries missed, including Obama, and this was where Gordon Brown was at his best. He said, "What we should do is some infrastructure spending, because giving money out doesn't produce economic activity, right? It makes people fat, dumb, and happy, and content being at home," which I'm against, by the way.
Yes, we've noticed.
You noticed, but if you start investing in infrastructure spending, roads, railways, towers, you know, airports, and all the infrastructure, it might not be growth now, but it's future growth, because you create more efficiency and so on, and it creates real jobs, creating those airports and bridges and so on, and it drives real income. And then the multiplier effect kicks in. So I think Gordon Brown was, you know, despite all his, you know, weaknesses, but in terms of his economic policy, it was absorbed. It was accepted by the G20, and Obama then went, and other advanced economies went on a infrastructure spending spree. And I think that is what's going to happen now. The US is due to sign a $2 trillion infrastructure program on the 4th of July, on Independence Day, and I think other countries should follow suit. It's a much more effective way of re-stimulating the global economy.
Stimulus. Okay, bail-ins like Cyprus that were being referred to from Don Vasey there. And Mark, the observation from Mark, the huge spending by the UK government is needed, but rather than efficient and effective policies, it is benefiting their own mates and funders. What on earth is 37 billion being spent on for track and trace? The high debt for the future inhibits socialist policies any further. So I think Mark's saying socialism now, but anti-socialism in the long term. The Greeks, says Gary, were close to defaulting, but the EU bailout prevented them doing so. So more debt. Where does that end? It's a question in everybody's mind here. So maybe finally for you, Paul, I know you got to rush off, but Gulzan Dur says, good morning. I'd be interested to know the current situation on taxes for foreign retirees besides the 10% NHR system, capital gains tax, corporate tax on revenue generated outside of Portugal. Do you manage that sort of thing, Paul?
We do, but we work with a lovely lady in Portugal who's part of experts in Portugal called Gilda Pereira.
Oh, okay, yeah, of course.
And I think we do, because we would look at the wider picture, not just at NHR in isolation, but but we work in conjunction with Gilder.
Yeah,
okay. It depends on what they require.
Yeah.
So we would look at the devil is in the detail. I'm happy to, if you put me in contact, to answer to Gulsen.
All right. So for anyone who hasn't seen you before on this slot or on one of our webinars, who is the ideal client for you? Who should be calling you?
People who are not on helicopter money. I mean, that's a starting point. Yeah.
Okay. So high net worth individuals who want who want some guidance on what to do with their money and managing it across these boundaries and borders.
Yeah, to manage the assets, to do things tax efficiently. That's our piece, really. Consolidating pensions. That's
all
what
right.
we can do.
We'll let you go off and do that now. All the best to you and to Elise today. It's great to talk to you. Look at this, Gary Austin. I like this guy. Will you come back and do more of these?
Absolutely. I'd be delighted.
Thank
you, guys. Thank you, Gary.
Seeing you on our next webinar, and I'm going to keep watching my gold stock. Thank you for that bit of education there, Paul.
Remember, Kinross. Gold.
Okay, he's making
that's a one to buy. That's my bold prediction for today. Buy gold miners, buy Kinross.
All right, cheers, Paul. Take care.
Thank you. Take care. See you, Carl.